Okay, and welcome back, students who are taking financial accounting. And in this last video, we are working on the theory for chapter 11, which is on the statement of cash flows. And at the end of the chapter, it is about the focus on decision making, or the financial analysis ratios. Let me erase here a little bit. Okay, so um, what ratios are we're looking at the end of the chapter? We're looking at our free cash flow, and we're looking at our cash conversion cycle. Okay. The free cash flow is our net cash flow from our operations minus the cash payments for investments and long-term assets. Um, you know, I I don't like the way the book is set up. That's why you saw I had to erase this screen, because they use a different example for the focus on decision making instead of relying directly upon what they've already presented. Right? If we're looking here at the net cash flow from operations, that number here is the net cash provided by operating activities. So that's 70,000. Okay, that would be what this number would be. But the example in the book goes and says, oh, we're going to look at something entirely different. Excuse me. They said our net cash flow was 160,000. Okay, now, excuse me, sorry about that. That's they should have just used the 70,000 and adjusted for it. Made the information a little bit more coherent. And then they subtract out, and in this case here, they're subtracting out 85,000, I believe it is, to purchase new equipment. Right. So that's the cash payment for investments in long-term assets, which gives them $75,000 difference. That's my free cash flow. That's money that's available to do whatever else that I need to do with it, whether it's pay dividends or buy new equipment or whatever have you. One thing to note, you might want to read the notation at the very bottom of that particular page. I'll read it here. It says free cash flow is often used to value a business. To do so, financial analysts measure free cash flow differently. Financial analysts add back the after-tax cost of interest to operating cash flow, producing an adjusted operating cash flow free of all transactions dealing with debt or stockholders' equity. The revised free cash flow is then computed by subtracting investments in long-term assets from this adjusted operating cash flow. The total value of the business, both debt and stockholders' equity, is then estimated using this revised free cash flow. And the way that notation was written more for somebody who was taking intermediate accounting. So anybody who's an accountant, you might want to pay attention to that notation. But everybody else who's in business management, marketing, human resources, or whatever have you, you don't have to really pay that much attention to that notation. Just realize that when it comes to doing the homework problems or a test problem, yeah, you might have to calculate this net cash flow from operations, and yeah, you might have to calculate the cash payment for the investments here, all right? But the information will be relatively simple, and you're not going to have to take into all of the intricacies that could be involved, that you'll learn about when you're actually doing intermediate accounting, all right? So just realize that, like I did here. Oh, I jumped up and said, okay, here's the $70,000, okay, from that statement of cash flows. Well, they were telling you it was 160, for the new example, and they were giving you the information of 85. They don't provide enough information for me to be able to pull down a number from the previous example. But all said and done, we're talking about free cash flow, the amount of cash available that you can use for something else. Okay. So number 2 is our cash conversion cycle. Right. We're going to add the day sale in inventory, and I believe that was chapter 5. Okay. So if you don't know how to do the day sale in inventory, go back to chapter 5 in order to figure out how to do that. Okay. You're going to, the problems and the exercises, remember, data will just be given to you, and it's up to you to know, as a professional, it's up to you to know how to manipulate that data to be able to use what you need to use. So you might be given a whole bunch of information, and if you don't know how to calculate the day sale in inventory, which, again, we covered in chapter 5, then immediately, your cash conversion cycle number is wrong. All right, so that's a nested calculation. Right, and then we have to add in the receivable collection period. Okay, and then we subtract out the accounts payable payment period. And notice that right here, all right, is the formula for the accounts payable payment period. We take our average accounts payable, right? So I'm going to have my average accounts payable, and I'm going to divide it by the cost of goods sold, okay, which is divided by 365. So this is what the formula actually looks like, written out in a more formulaic view, right? So my average accounts payable, remember, is the beginning accounts payable plus my ending accounts payable, and that's all divided by 2, right? That's how I get my average. And you should be familiar with that from the previous chapters. I don't remember exactly where, but um, I went through the spiel on how to calculate the average. So really, this really shouldn't be anything new, right? And as far as the cost of goods sold, remember, cost of goods sold is revenue, and then you are given your cost of goods sold, which gives you your gross profit. Well, not given. I mean, you might have to calculate your cost of goods sold, but generally you're moving from inventory to cost of goods sold, and that's the number you're picking up from your income statement. All right. Boy, oh boy. Ping. How did I get ping? All right. So yeah, that's the cost of goods sold is on your income statement, and you're going to pull it and use that as part of the calculation. Take that number, divide it by 365, and whatever amount you get in your denominator, you're going to divide it into whatever number you have in your numerator, all right, to get your accounts payable payment period, all right? And then, of course, that figure is part of your cash conversion cycle, all right? By adding in the days sales and inventory, add in your receivable collection period, and then subtract out your accounts payable payment period. Right? I'm not going to go doing all of the math and be making up numbers and plugging them in here. Go ahead, read the textbook. Just realize that when you're reading the textbook, it's they're giving you a new scenario with new numbers to play with, and they're not really pulling it from the previous information that you had throughout the rest of that chapter, which is a shame. The cash conversion cycle, that's important to know because remember, cash is king, okay? And you want to be able to, how quickly can you convert things into cash? So you're really looking at, when you're thinking about it, you're looking at, how quickly you're selling your inventory and you're collecting your accounts receivable, and how quickly you're paying off your accounts payable, right? Because cash is cash. You're not, you can't change that whatsoever. But then the next thing you're looking at is your accounts receivable and your accounts payable. Well, you want to know how quickly you can convert that into cash, because you may have to, if I have my cash here, which is an asset, right? And over here in my liabilities, right, I have my, accounts payable, my notes payable, my long-term payable. Remember, these are things that you owe. And the reality is if they say, hey, we want that money now, okay, then you have to owe it now. I mean, that's credit. It's only loaned basically on terms. But the reality is if we go back to the first video here when we're talking about the cash versus accrual, right? Just because you set up an account with Home Depot, okay, doesn't mean that you get 30 days credit and you can wait the whole 30 days. No, they can call those loans in anytime they want. And it's the same thing with notes payable and your accounts payable. So you want to always kind of like keep that in mind, especially in terms of your notes payable. All right. long-term payables, like your mortgage and stuff like that, the banks aren't going to just one day, run up and say, hey, pay me, what you owe. Okay, that's kind of ridiculous for them. But when it comes to notes payable, if it's a 30-day note, 60-day, 90-day note, and the party you borrowed it from, for whatever reason, needs that cash real quick, they could come to you and say, give it to me. Okay, and then you have to come back and look at your cash to say, do I have the money to give it to them? And if not, what do I have in receivables and what do I have in payables in terms of my cash? How quickly can I convert things and pay off into cash in order to pay off those liabilities? And that's why we look at the cash conversion cycle. All right. So with all of that said, and done, go back and watch the videos again. Hopefully the series of videos, again, it was cumulative, one building upon the other. And the most important thing is to get to these here formats of the statement of cash flows, and you saw you get the underlying thought process and the concepts as to how to arrive at this instead of just looking at it and going, oh, how do I put this together, right? There's a logical progression, and if you think about the net effect on cash, um, as to what that account is, like depreciation being a phantom expense, it's offsetting, it's just adjusting the book value of your asset. It doesn't affect cash in one way or the other. So if you're subtracting it out on your income statement, you have to add it back in order to see the net effect on your cash from the net income perspective. So as long as you understand, the concepts, um, for each and every one, then it's just a matter of following a process, a quote unquote step-by-step checklist, in order to be able to create your statement of cash flows. And this becomes easier as soon as you do one or two of them, and uh, as long as you understand those concepts, everything will fall into place. So watch the videos again if you need to, especially if you're doing the homework problems. And of course, you'll see them worked out in the homework problems. And if you still don't understand something, feel free to contact an instructor. Okay. So we'll see you for the short exercises in the next series of videos.